So, good morning, everybody. Super excited for this morning. I think we have a very exciting discussion that we're going to be having, a very relevant discussion for today's times. So, before we get started and jump off, wanted to share a little bit about what we do and how we do it. So, if you could, I'm going to be sharing my screen real quick. So one of the things is that I'm really excited about is that both Stuart and we're a very forward-looking organization, and we focus and we help individuals on personal planning, advanced tax planning, and business strategy. And what's really important to note is that the goal of both our organizations is to really help individuals move the needle from being reactive to being proactive, so that you can make smarter decisions and protect and grow your wealth. The way we do that is we have a very holistic and comprehensive approach that integrates strategic partners, sophisticated planning tools to provide a broader scope of service. And this is what our best clients want. And our mission is to really be able to maximize your personal or business financial potential, right? So that we're the most relevant proactive advisors. And the way that we're able to do that is we have a very team-based approach. I don't believe any one person has all the knowledge in the world. And then I don't want either of us to pretend that we have all the knowledge. However, we do know all the right people that have all the right knowledge to be able to help you. So our team-based approach is that you as the client, when you're working with us in the proactive planning team, which is made up of multiple individuals, well, we're able to address typically about 70 to 80% of your needs. However, one of the unique parts of our model is that we're able to, if there's any area that's outside of our area of expertise, we're able to lean on our virtual family office, which it's a multidisciplinary approach, and we have 5 different areas that we have experts in, advanced tax planning, risk mitigation, wealth management, legal services, and business advisory. So it's really combining proactive planning with the virtual family office experience. And today, I'm just going to showcase just a little bit about what are the areas of service, and then we'll just get jumping into our topic. So our virtual family office showroom, if you think of it, is like you're going into a department store, and it's like you have 2 lanes, right? 2 aisles, and on one side you have the business planning side, and then you have the individual personal planning side. Just in a nutshell, from the business planning, we do all the things from financing, reducing costs, taking care of employee or government benefits with the CARES Act. We also help a lot of individuals and companies develop employee retention strategies and retirement plans. And we help organizations grow with business strategy and think about succession planning and exit planning. And we also do the risk management as well too, right? Now, on the personal planning side, we focus on investments, which is going to be part of our conversation today, retirement planning, Social Security maximization, college expense planning, and safe money option. Again, that's going to be part of our discussion. And advanced tax reduction, which is really relevant in today's environment, and asset protection. Legacy planning, we do from estate planning, will, charitable giving, all of that. Risk in insurance, from life insurance to health to travel, disability. And the main idea is that it's a one-stop shop, because how often do we have CPA, an advisor, an attorney being able to collaborate together and communicate together? It's very rare. So the point of what we do is to be able to make sure that all of the financial professionals or all the professionals are working comprehensively together to make a unified and comprehensive approach to your to achieve your financial goals. So that way you don't have to deal with 10, 15 different financial professionals or so. So with that being said, that's just a little snapshot into what we do, what we're passionate about. We are heading into a recession, right? And so what does that mean? And what should we be doing about it? So for that, I'm really excited to introduce Stuart. And Stuart, just to give you a quick background, there's not enough that I could say about him. There's so much. He is a highly
checks in the mail.
Thank you. But Stuart really, he's a highly accomplished as a quantitative investment advisor, a TEDx speaker, and author, a VC.
Pavan, you're freezing up on me a little bit.
Working decisions on math, theory, number cruncher, and expected value, and is driven by a mission to revolutionize. What was that word?
Pavan, you froze up on me a little bit. So I don't know if the rest of the guests can still hear you or if I'm the one who's frozen, but you look frozen to me on your screen. Oh, we dropped Pavan. So I know he was introducing me a little bit. I'm sure he's going to jump back on in a second. And while he's away, Pavan he's an advisor, author, speaker, visionary leader. As you can see, we are going after this more holistic and comprehensive solution. I think it's pretty obvious. Do you want your advisors to play as a team, or do you want them to play as an individual in their individual silos? I know when I was first working in this field, I would try to do all my work in an individual silo, and I was kind of in competition with people like Pavan for the assets of yours, which is not in your best interest, clearly, right? As a fiduciary that I am, we have to act in your best interest. And I think the only way to do that is in a team-based model. When you're working with the other experts like Pavan, or like your estate planning attorney, or like your CPA. When I was at Bear Stearns, or a big broker dealer, I was at Lehman Brothers before that, and I left before the financial crisis, we were not allowed to work with the other advisors. Compliance prevented us from cooperating. It seems crazy. That's still the case now, actually. I had a buddy of mine that I play basketball with, and he said, this is how bad compliance gets. He said, when I get up at 3 o'clock in the morning to go get a glass of water, compliance hands me the glass. Because I can't do anything that's outside of what we're allowed to do. So I can't have a conversation with the CPA or an insurance person or a estate planning attorney or a tax mitigation specialist. Heaven forbid. They can't solve problems together. It has to be in their silo. So when you're looking at what's the best solution, team-based model, clearly it's got to be the better solution for everybody who's out there. And Pavan, you dropped off, and I introduced you a little bit while you were regaining your internet connection.
Thank you, and I appreciate that. Sorry about that. I don't know why it randomly shut down for a second, but
all good.
I don't know where what you heard from me before, but I was introducing you, and so I wanted to have the audience hear a little bit just about your background, because I think you have a wealth of knowledge, and you're a person that really understands numbers and data. But what's great about you is the story that you're able to stitch together to make sense out of that data and the math. And so just for the audience, I just want to let you know that Stuart actually wrote his first book, License to Steal, turn Walmart Street Greed into your gain, which really is interesting. It offers insights into the pitfalls of investing from both industry and investors' perspective, but really to empower readers to like navigate, biases and maximize financial gains. And some of his other key achievements is he was actually involved in taking real estate investment trust, the REIT, public on the American Stock Exchange in 1977.
97.
97.
I'm not that old. I'm pretty old. Pretty old, but not
You're
that
paying attention, right?
Yeah.
Yep.
Yeah,
And
GTA, Golf Trust of America.
yep. And he's provided expert guidance for over $1 billion in assets. But really, what I love about Stuart is his guidance is grounded with statistical principles based on a successful quantitative value portfolio. And every time I talk to Stuart, I learn something. And so without further ado, Stuart, I'm going to hand it back over to you, sort of to discuss on current economic conditions and indicators. Maybe you could touch on the anatomy of recession and start us on the conversation on positioning yourself and taking advantage of the recession. And for everyone, this is intended to be a dialogue. So if you have any questions, please put it in the Q&A, and I'll ask Stuart. I'll pause him and ask Stuart. So let's get started.
Yeah, I'm sure they're tired of hearing about us, and so let's jump into this. We were talking about really the big question on everybody's mind is: are we going into recession? If we are going into recession, what happens? What should we do? How do we protect our portfolio? There's a lot of what ifs out there. So the Federal Reserve finally said that they are going to have 3 negative quarters of GDP growth. So that's an oxymoron, negative growth, right? So 3 declining quarters of GDP. Now, a loose definition of a recession, it's not the official definition, but a loose definition is 2 consecutive declining quarters of GDP. And the Fed finally said we're going to have 3. So while that's not the official definition, there's a lot of other metrics that go into it. We're probably heading into a recession. Now, why do I say that? We've been calling for this for quite some time. Up on the screen right here, I have the federal funds target rate right now, the low end. And as you can see, this is a chart. We were right through here where we were at the Fed funds rate at 0 for quite some time. And then the Fed just started raising rates like crazy. And if you can look back, this chart goes back, 25 years or so. It's clearly the steepest rise in the last 25 years, and everybody knows that. So that's somewhat problematic in the fact that the Fed realizes that they were behind the curve. Now, keep in mind, when the Federal Reserve raises the interest rates, it takes somewhere between 6 to 9, maybe 12 months for that interest rate increase to start working its way into the economy and for the effects to be felt. Okay, so the majority of these rate increases that we've seen aren't even in the economy yet. So keep that in the back of your mind. So why did they raise interest rates? And hey, people have been calling for lower interest rates. We've had those 2 bank failures. So doesn't that help with the, with the inflation problem that we have? Because right now, the Fed has a little bit of a trouble. They have high inflation, and they're trying to slow the economy down, but they're trying not to go into a recession. So let's take a look at really what's going on, in my opinion, with the Fed. This is pretty simple stuff, actually. So here's the federal funds rate, and I'm going to put on the 2-year Treasury. Now, the Federal Reserve sets the federal funds rate, that purple line. But the markets set the orange line, the 2-year Treasury rate. The 2-year Treasury rate.
Stuart, I think you see your email and
Oh, that's it? Oh, we're looking at the wrong screen?
Yep.
Sorry.
There we go. Oh, there we go.
I shared the wrong screen, apparently.
No worry.
Okay. So appreciate that heads up. So here we are at the Federal Reserve funds rate. And let me just step back. This is the low end of the Federal Reserve funds rate that has jumped up consistently. Now, if I show you a max chart that's 25 years, this is the steepest rise that we've seen in 25 years. All right, this is where we're at right now in this curve. Now, if I add the 2-year Treasury rate onto here, now the 2-year Treasury rate is nothing more than if you give the federal government a loan for 2 years, what interest rate are they going to pay you? So we peaked out kind of back here at around a 5%, and the federal funds rate is at 5% right now. So what is happening here? What's the dynamic within the economy? Well, anytime the 2-year rate is above the federal funds rate, anytime the orange line is above the purple line, that is inflationary pressure. That's inflationary pressure that is going to be felt in the economy in the future, some 6 to 9 months in the future. So back here, and we're going to make this chart a little bit smaller. Let's go with a 3-year chart. So back here, if you recall, Jerome Powell, the Federal Reserve Chair, was saying inflation is transitory, meaning we see the inflation kind of picking up. We see the 2-year moving up, but it's temporary. It's not going to last. But that's not what happened at all. Not only did it not decline, it started picking up speed. And he was still sticking to transitory. But no, when you look at here, if the 2-year is here and the Federal Reserve funds rate is there, that gap is inflationary pressure to be felt later. So not only was the inflation not transitory, but it was picking up steam. And now we have more inflation pressure in the economy that's going to be built up. So that's when the Fed started raising rates, and they raised it 50 basis points. But the gap got bigger between the 2-year and the federal funds rate. So they raised it again. The gap remained extremely large. And every time this gap stays open and wide, that is more inflationary pressure to be felt in the future. So then they started raising it 75 basis points. Now, they're raising it because the Federal Reserve has never successfully been able to fight inflation with the federal funds rate below the 2-year Treasury. So every time, and as much as you see this purple line being below the orange line, that means inflationary pressure is in the system and will be pushed into the system in the future. So not only are we fighting inflation, but we're fighting inflationary pressure in the future too. So that's why Powell was saying things like we're going to keep raising rates and we need to keep this higher for longer than you might think. That was his rhetoric. Now, right in here, it looked like the 2-year was starting to trail off, but this is literally the first time that the policy was starting to get a little inflationary fighting pressure in the economy. Just this little portion. And then it continued to rise. And right here was when those 2 banks failed, Signature Bank and the other bank was Silicon Valley Bank, the more famous one. So when they fell, that reduces flow of assets in the economy, and it actually is deflationary. So it dropped, which is a good thing for Powell in the sense that the 2-year is now below the federal funds rate. And this, for the first time, is consistent disinflationary pressure. However, we still need to make up for all the area that was formed prior to this event happening. Prior to the orange line going below the purple line, we have to make up for this big area because that is all inflationary pressure. So we learned that about the 70s and 80s when Volcker, well, the predecessor of Volcker, was fighting inflation. And what would happen is the 2-year would drop below for a little bit, and then they would drop the federal funds rate. And lo and behold, inflation would rear its ugly head again, and they would have to continue to raise interest rates. And then there would be an inversion of that curve, and then they would drop them again. But this pressure would enter the system later, and they'd have to keep fighting that battle. Volcker stepped in and said, we are going to keep the federal funds rate above the 2-year Treasury rate, and we are going to squash inflation. Because the number one predictor for future inflation is expected inflation. It's the number one predictor. So right now, we still have the 2-year rising. So even though we had a gap here, it made up a little bit. It's rising again because of all this pressure. That's why the Federal Reserve thinks they still probably have to continue to raise and keep this purple line higher than the orange line for a longer period of time. Now, right now, the markets say that there's going to be a decline, or they're going to drop the federal funds rate probably in November or December, and the odds are with them. I am not so sure, because this whole gap and area needs to be made up on this side, and we only have a few months to do it. So I think, again, Powell's going to be very true to his word and say we're going to keep it higher for longer. Does that all make sense, Pavan?
Absolutely. Yeah.
Okay.
I mean, this is really interesting because, you know, for most of us, we think that, you know, people are talking about recession, but Stuart, I see stocks going up. You know, I don't really feel the recession.
Some stocks are going up. Yeah.
Yeah.
Just some stocks. Well, let's talk about just some predictors and leading predictors of the recession. So I can say now he's trying to fight inflation, right? So he's trying to slow down the economy. And people point to unemployment. Unemployment's super low. Anybody who wants a job can probably get a job right now. It's 3 and change %, and that is inflationary pressure too. So he's got a very, very narrow window, Powell, to thread through. So let's take a look at a couple other things. I'm going to add the 10-year Treasury. I'm going to take the Federal Fund Reserve off of this chart. Okay, so now I have sorry, that's the spread. I have the 2-year Treasury and the 10-year Treasury. So the two charts are what is the amount of money that you're going to get? What's the interest rate return that you're going to get for giving the government for 2 years versus 10 years? And most people, think about when you give the money to somebody for 10 years, you get a higher rate of interest, and that's generally true. So if I were to look out over the last 10 or so odd years, then you have this orange line, and I'm going to ask you, can you see the Zoom kind of menu down here?
Yeah.
You can. All right. I'm going to stop sharing my screen for a second, and I'm going to share the screen here. Is that better?
Yeah.
Okay, cool. Okay. So normally when you give the money to the government for longer, you expect a higher rate of return. And that's normally what you get. So to put things in perspective, again, this time the purple line is the 2-year Treasury, and the orange line is the 10-year. So if we give the government money for 10 years, we get a higher rate than if we give it to them for 2 years. Okay, that makes sense. Normally that's the case. So as we look through here, the orange line is above the 10-year. They're kind of on top of each other. And now they're reversed. So now if I give the government money, I get 4.46% return on a 2-year and only 3.69 on the 10-year. That is the market saying that there's economic weakness ahead. That's the market saying that interest rates are going to be lower, but that we're in trouble. What that is called is an inverted yield curve. All right. Why do we care? Well, an inverted yield curve is a pretty good indicator for recessions. So what I'm going to do is I'm going to make this a max chart. So now we can see a long period of time of the 2 and the 10-year, and I'm going to put on the U.S. recessions, and that's going to show up in gray bars. Okay, so we can see all the gray bars are when we've had a U.S. recession. All right, now this chart is pretty complicated. So to make it a little easier to see, when you look at what we're looking for is the 10-year minus the 2-year. Whenever the 10-year minus the 2-year is negative, that means it's inverted. So I'm going to clean up this whole chart and put on the 10 minus the 2. So whenever this number is negative, that's an inverted yield curve. Whenever the number is positive, that's a normal yield curve. All right, so here's the 0 number. That's the 0 line. And let's see if we can determine a pattern here. We go below 0, we get a gray bar. That means we're in a recession. We get a below 0, gray bar, recession. Above 0, good, good, good. Below 0, recession. Above 0, below, recession. Above, below, recession. Above, 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 above. Touch the line, small recession. We are now more inverted than we have been since the 80s. Okay. I don't know how we avoid a recession with this inverted yield curve as steep as it is. Now, there's two other things that tend to predate a recession, and that is higher energy costs, which we have, and a tightening Fed, which we have. And they're tightening it in a strong way. So those three things, one of them always precedes a recession. All three of them are in play right now. So my analogy to this is somewhat of, the Federal Reserve makes a move in the economy, and they're making a move based off of data that's a few months old. And their move that they make in the economy it takes 6 to 9 months, sometimes 12, to work its way into the economy. So picture this, you're driving your car. Instead of looking out the windshield and seeing real-time data, you see data that's delayed by 2 or 3 seconds. Okay? And then when you turn your steering wheel or hit your brake, nothing happens for 9 seconds. That's what the Fed is trying to operate the economy with, that kind of analogy. They have old data, and then anything they do doesn't happen for a while. So if you're going down a straight road and everything's clear, probably going to be okay. But if a hazard comes up, you're probably going to crash. And that's what we're talking about. I do not see how the Fed can navigate without crashing. They're doing the best they can. They just have a very difficult job. All right. So when we're talking about what to do now when you have a recession, this is from our friends at JP Morgan, Guides to the Market. I like this chart. They put on a lot of data. So how we'd read these 9 individual charts. These are the last 9 recessions we've seen going back 80 years. The green line is the S&P 500, how the S&P 500 did during that period. The gray line again, or the gray band, is again a recession. And then that black band below is the low that market had during the recession. And the purple line is the unemployment rate. So let's look at some similarities between these 9 charts. We have kind of a flat line, a meandering of the S&P 500, and then it retests the lows in the recession and then rallies after the recession. We're just going to focus on the green line right now. This green line drifts down and forms deeply new lows, but then rallies. Deep new lows, rallies. Meanders upward, you might argue, but then rallies. Retest the lows, rallies. Retest the lows, rallies. Deep new lows after the recession. Deep new lows in the recession, again, a rally. And then retest the lows and a rally. So in 8 of those 9 cases, the S&P either retested the old lows, which is about 15 to 20% down from where we're at right now, or forms deeper new lows. Okay, we're a quantitative house, as Pavan suggested. Every decision we make is math and statistically related. If you have history that said 8 out of the last 9 times, you've either formed new lows or retested the past lows, or you formed deeper new lows, I'm going to place a bet on let's be a little bit more protective with our assets. In almost no cases, this drifted up for a little bit, but it still didn't go crazy until you were in the recession and looking through it. Because again, the market looks through events. So if we do believe there's going to be a recession, it probably won't be until we're in it that we're able to look through it and the market takes off. So in spite of this current rally in some, I think, spawned because of some of the AI rhetoric that's out there, we're at high market multiples right now. In spite of that, I think we're going to have a retesting of the lows. Do we hit the old October lows? I don't know. But it still could see a 10, 15% decline. Now, what about the unemployment? There's an argument that, hey, we have low unemployment, so how could we go into recession? Well, again, look at the charts. Low unemployment, and then it spikes in the recession. Low unemployment, spikes. Low unemployment, spikes. It's the exact same case every single time. It's the unemployment that rises during the recession, but it doesn't prevent a recession from happening. So it's not like a causation of low unemployment will stop or prevent a recession. The recession causes the unemployment to spike, right? So that's what we are anticipating, is a higher level of unemployment once the recession starts. that pretty clear?
Makes absolute sense.
So what to do? I mean, what we just talked about, right? If we think there's going to be a decline in the market, now tech has done great because of AI. And so there have been some nice pockets that have rallied, but I could argue that most tech is just as expensive as it was the pre-2022, where the market sold off. Tech sold off 30-some%. I don't know what's going to happen, but whenever multiples have been where they're at, the forward 3, 4, 5-year returns have been very lackluster. And if you actually did a regression, which we do, because that's what we like to do is the math, you have an expected rate of return in the S&P of close to 0%. So we would expect to pull back coming into this recession. So how do you protect yourself? Right? We can talk about ways to protect yourself. Now, I'm an asset manager and I do asset allocation. Pavan protects assets in a different way. That's why we work together as a team to provide value for the clients, as opposed to arguing with each other what's best, and the client being the middleman between trying to decide who's the better salesperson on their argument. It's obviously a much better solution if we can work together and say, hey, part of the solution might be we're in treasury bills, or we have some assets that are protective of the market going down. And maybe then there's some assets that Pavan will employ, like annuities, and I'll let you talk about them, or life insurance, that we can take advantage of, knowing that these things cannot decline in value, even if we do have one of these deep sell-offs that we've seen in a lot of these recessions. So I'm going to stop sharing my screen there. You want to take over on your side of the asset protection discussion?
Sure. Yeah. Happy to. And let me jump in on that, sharing my screen. So to what Stuart was alluding to is that in a recession, there's obviously a lot of different things that we can do. On the asset management side, there's some unique tools that are typically not available to or not necessarily employed by a DIY investor, right? So you should definitely talk to Stuart and I to see what are the options, But when we think about safe money options, we should be thinking about, hey, what are options that can reduce market risk? And an example that Stuart mentioned was, annuities, And most people think about annuities as, hey, isn't that for when I grow older and use it for income? Actually, there's two sides of annuities. There's annuities that are for growth, and then there's also distribution. And today, there's index annuities which are able to really hedge against, when market goes down, and you're able to have principal protection, and you're able to have really good potential opportunity for growth. So that may be an option. But then there's also things that, you may be thinking about, hey, the political climate is pretty volatile, and we need to think about how do we reduce market and geopolitical risk. There's non-traditional avenues that we can explore and look at that can actually address some of that. The other thing that we have to think about is it's not just always chasing after ROI, but it's also about where we put that growth opportunity, right? And that's where we have to think about, is there any opportunity when we're investing? Can we consider things that also have some tax advantages as well too, right? And I know Stuart I hope that you can also touch base on a little bit of municipal bonds and other areas as well too. But there's quite a few options available for individuals. Now, one thing I will say is that, and a strategy that I sort of want to introduce, it's sort of like a new era of investing, and this is employed by indexed annuities a lot, but it's not necessarily really aggressive bull market investing, not necessarily bear market investing, and we call it, white swan market investing, right? And the concept is really just being able to sleep well at night. And what does that mean, right? What if you were able to go up with the market, when the market goes up to a limit, right? And not being too aggressive, But then when the market goes down, every time the market goes down, you have downside protection, right? And you've locked in your gains. So because you're locking in your gains every time and every year, you're able to compound, right? And so in a sawtooth marketplace, this can be a great way. And this is just sort of an example, right? When market is going down, you may not gain anything, but you don't lose. But when market goes up, you can capture some of the gains to a limit, right? In some cases now, we have strategies that don't even have caps on those as well too, right? So this is a great way of leveraging the power of indexing and compounding as well. So, but is that meant for you? I don't know, right? I think there's no cookie cutter approach. And this is what Stuart and I really believe. It has to be hyper personalized. It has to match, your risk profile. It has to really be able to match what you're looking to achieve in terms of your goals. And there could be a great combination of some of the solutions in the marketplace and some of the solutions that are safe money options combined together in your portfolio. So, Stuart, do you want to touch on, I asked a question. I had a couple of questions that had come up. And
Sure.
let me just sort of ask some of those, and then we can wrap up. So one of the questions that had come up was, what are your thoughts on, again, the tech stocks that are going up? And then also, any thoughts on, the debt ceiling? I know it's supposed to be resolved. Is there any potential future impact?
Well, I mean, hopefully it's going to be resolved. But if it's not, that's just recessionary pressure, right? We're not meeting our obligations. You're going to, the definition of inflation and is the velocity of money going through the economy. And during 2007, 2008, the reason why we went into such a deep recession is because the banks stopped lending to each other and there was no money moving through the economy. It didn't matter how much they tried to spur economic activity, it just came to a grinding halt. Banks weren't lending to each other or to people, so there was no movement or velocity of money in the economy. So if you stop that velocity of money through a default for the federal government, that's problematic. That does nothing more than just add a tremendous amount of recessionary pressure to the economy, which I think we're going to get anyway. So it could be quite bad. It could be one of those deep, deep recessions. So you're trying to hope for a soft landing or a softer landing. It could be a pretty hard landing. But, hopefully their politicians are not too obstinate, that they can figure out a way to shake hands across the aisle and come away with a deal where everybody's mad, right? That's usually a successful deal. But let's talk a little bit about the tech stocks. So I like to go with Apple just because it's a bellwether. Everybody's familiar with it. Probably a lot of people own Apple stock. It's a lovely company, obviously. First, $3 trillion company. It's phenomenal. Dented the universe, as people might say. People love their products. Nothing bad to say about Apple, but is it a good investment moving forward? I don't know. So let's take a look at, this is the price of Apple. And I'm going to put up just one measure. PE ratios tend to be a pretty good measure of valuation. And in my research, when you look at buying low PE stocks versus high PE stocks, low tends to outperform over the long term. Doesn't always outperform, but it does tend to outperform. Warren Buffett would suggest you buy lower PE stocks than higher PE stocks. He is a fan of Apple company for sure. So let's just take the PE ratio of Apple on here right now. And I have a 10-year chart up here. So this is how I'm thinking about, and this can be pretty much applied to most tech stocks right now. This is COVID, 2020 right here. Okay? It's COVID. Now, prior to COVID, if I had to eyeball it, and we could even put up this chart if you want to. If I had to eyeball it and say pre-COVID, where did And let's just do the 10 years pre-COVID. Where was Apple stock PE trading? You could argue it was around 16. Okay, I could even throw in an average line there. 15.86, pretty close guess. All right, so around 16. That's about the market average, right? 16.
Yeah.
Pretty normal valuation. It obviously traded below and it traded above. It started to spike here. Why did it start to spike? Well, it started to spike because the federal government threw $7 trillion at the COVID problem. And so where could that money flow to? It flow to tech stocks because everybody was at home. It made a lot of sense that technology was going to be the thing that, you know, generated the economic activity within the economy. So that made a lot of sense. But if you recall, only like 5 names, Apple, Facebook, Google, did well. Netflix did well during COVID. Most of the other stocks in the S&P 500 were negative for the vast majority of the year. But so it trades at 16. I would call that its natural level before any economic stimulus. Now, if we look over the last 5 years, this includes some of the COVID numbers, or even the last 3 years, it's trading at an average of 28. It's right now at 30. So almost twice what its normal, what I would call its natural average. Now, PE ratio is nothing more than the price that you're willing to pay for a dollar of earnings of Apple or any stock. PE is price over earnings. How much are you willing to pay for a dollar of earnings? So pre-COVID, you're willing to pay 16. That means for every dollar Apple made, you'd pay $16 for the share of stock, meaning you would get paid back in 16 years. But now that number is 30. It doesn't trade at 30 naturally. On top of that, interest rates are higher. So if you have a higher interest rate, that depresses multiples. That means any future money you make should be discounted more back to current days. That means the multiple you're trading at shouldn't be 16. Maybe it's 15, 15 and a half. I don't care. Maybe it's a little bit 14, whatever. But is it 30? Probably not. So am I going to say Apple could sell off by 50% just to hit its valuation? Now, do I think that's going to happen? No, I don't think that will happen. I think Apple is just too big of a name and held by too many people. But what could happen is you could have extremely lackluster future performance in Apple until its earnings catch up with its PE, its price. We've seen that over and over again. That's how I'm thinking about a lot of tech stocks. Not that the company's still going to be great, still making awesome products. I wanted a little caveat. Apple's not growing any faster than it did pre-COVID, post-COVID. It grows at about 5 to 10% a year. It's not like 45, 5 to 10. So not a huge number, certainly doesn't require a 30 PE on it. So how I think about most of these stocks is that you're going to have kind of a regression back to a mean or a lackluster return until the earnings kind of grow into the PE ratio. Same thing for Google, Facebook, Microsoft, Netflix, Amazon. The same argument can be made across the board for all of them. NVIDIA probably got a lot of attention recently because it owns 90% of the chip sector within the AI market. So it gets a lot of attention. But anytime NVIDIA has been at these valuations, the next 3 to 6 months have been pretty severely negative. So again, awesome company. But if you're looking to buy NVIDIA right now, especially heading into recession, and especially with these companies heading into recession, you might get some regression back to the mean or some sort of return to more normal price levels.
Awesome. Hey, Stuart, we have another question. Do you have an estimate based on data on how long will this recession last and the severity of it?
Well, that's a $64,000 question, right? And I'm probably one of the old people who actually have never seen that game show because, but let's just go back to our windows. A lot of times these recession will last. So here's COVID. It only lasted, like a quarter. It was pretty brief, but they'll usually last like 6 to 9 months. But that's okay. It doesn't mean the economy or the S&P or the markets are going to be in the doldrums for 6 to 9 months. In fact, if you look, they usually bottom out somewhere in the middle. This was an anomaly here, but middle, early, late, middle, after, and then early. So normally somewhere in I would call this a normal recession. So there wasn't a global pandemic or some sort of weird set of events around it. It doesn't seem to be different this time in this particular event. Like I would call, this even looks like a different chart. That the COVID recession was a very, very different set of circumstances. But for the vast majority of the time, it's going to last like 6 to 9 months. The market will bottom somewhere in the middle there. Probably will get, I'm hoping we're going to get some sort of capitulation event or just some sort of sell-off where the market, the Dow is down 1,000 points, 1,500 points in a day. That's a really good time to start stepping back in. When you just feel bad, it feels horrible. You have some cash on the sidelines. That's a great time to step in when everybody is very unhappy.
Awesome. And the other question is, will the market or real estate market bottom when the commercial real estate is at the bottom, I guess? That's the question.
Will the commercial real estate bottom the same as the residential, or is it when will the commercial real estate bottom? Was that more of the question?
I think it's more of when will the commercial real estate bottom?
So I'm hoping, I think we are seeing some reasonably more economic activity, or we're seeing return. We are in Chicago right now, so we're seeing some return back to the offices in Chicago. We're seeing some evidence that it makes more sense for people to be together, to collaborate. It's one thing if you have a group of people that know each other and are attuned, and then you send them all to Zoom into their separate locations and they can work well together. It's another thing when you start getting new people coming in who don't know how each other works and they haven't really formed a relationship yet. And so I think some companies are seeing that you need to have that interaction on a daily basis. So it'll be some sort of hybrid, but generally what happens is, so you're getting that return back to the office, but clearly if we go into recession, again, all of this activity will stop and people will stop the hiring. They won't be expanding their services. There won't be, the real estate market will get depressed. So it would make sense that it would bottom out kind of in the recession. And in the last several recessions we've seen, 2008, COVID, even during the dot-com to some extent, but during those last few recessions, there was a phrase that correlations were going to 1. So what does that mean? Correlation coefficient means how much do things move together? And if they move exactly together, they're correlated. They have a 1 correlation. If they move exactly opposites, they have a -1 correlation. If they don't move at all together, it's 0. And as an asset manager, we're looking for 0 correlation. If I can find an asset that has 0 correlation, that doesn't move at all with the S&P 500 or bonds or real estate, that's a great thing. And that usually helps make the portfolio more efficient. When correlations go to 1, that means everything is moving together. So if you recall, real estate in 2022 was the same thing. Real estate was down, bonds were down, stocks were down, crypto was down. Like pick an asset class, they were all down. Same thing in COVID, same thing in 2007. So I think in this recession, you're going to see a very similar situation where the market will be down, crypto will be down, real estate will be down. Bonds probably won't be down because what will happen is interest rates should start to drop, and it's just bond math that sends bonds higher. So if interest rates go down, mathematically bonds rise. It's not a speculative thing. It's a mathematical relationship. So you might get a little bit of an inverse with the bonds, but that's what I think will happen to the real estate market. You'll get a depression during the recession.
Right. And so a follow-up question is, advice for a prospective new home buyer. And I'll add my thought, and you can share too, Stuart, is, I think, right now with what Stuart is saying, this is just my opinion. I feel that there's opportunity for price adjustments to happen in real estate, but also interest rate is super high. So your buying power of home is going to be reduced with such high interest rates. So I think there's opportunity if you are willing or if you have the ability, you can wait. Now, if there's an urgent need, I'm always a believer that if it's a need, then go ahead for it, right? But if it's a want, you're looking at it, you're thinking about it, and you haven't bought into it yet, well, can you wait a few more months, or can you wait and see if there's an opportunity to buy it at a discount? So
Yeah, I 100% agree. If you have a need, do it. If the markets come down, you can always refinance. So here's the 30-year mortgage rate. We were super spoiled for some very long period of time, right? Hitting the threes, coming way down in here into the twos. That was just craziness. And then a big spike. So we're up at the 6.5s, and it looks extremely painful, which has killed 80% of the new home purchases in the mortgage environment. It looks like we kind of like settled off. And if we do see the 2-year treasury, and really the 10-year is kind of what tends to be a indicator, but not always. So you see this gap, it tends to be pretty similar, and then it widens here. All right. So I might suggest, as Pavan suggested, that you're going to get a narrowing of this gap. And it's not because the 10-year is going to move up. It's probably because the mortgage rates will move down. But if I look at this over a long period of time, I'm going to take the 10-year off so it's not confusing. Here's the mortgage rates over the last 20, 30, 40 years. We're not historically really that bad right now. So I do think when we see a recession, you're going to see mortgage rates drop. So there'll probably be more opportunity. But if you have a need, it's not historically an awful period to buy.
Yeah. Yeah. And then I think that one of the final questions that we have is, what is the criteria for becoming a new client, net worth or income? And, I can say that, for us, we don't necessarily have a hard criteria, but it's more of a soft criteria. Typically households that have income above 250,000, or they have some set of assets that they're looking to be able to address, or if they're paying significant amount of taxes, then it could be an area of value. And now that doesn't mean that we can't help somebody that is below that, or in any sense. It just means that there's a lot more that we can do if you're at that criteria or above, right? So it's not just asset management or not just tax planning. There could be multiple things that we were able to help with. Hopefully that addresses it. Stuart, do you want to add anything?
Yeah, that's pretty similar to us. I mean, we obviously think we provide more value if your portfolio is bigger. We do provide a lot of other alternative types of strategies outside my quantitative QVP. We'll provide option strategies. We use structured notes, which most people have never even heard of, but it's a $4 trillion asset class that's used by institutionals, helps protect on the downside, and could potentially give you leveraged upside. You can't go into your local bank and buy these things. It's just, and a lot of brokers can't even sell them either because they're so quantitative in nature. Their own firm won't allow them to be sold, but they're a great tool. So as Pavan talked about before, it's very individualistic, right? So to really answer your question, I know I've been dancing around it. If you're in wealth accumulation phase and you're a high income earner, we can probably help you. If you've already amassed a set of assets, we can probably help you. If you don't have a big portfolio and you're spending it down, maybe we're not the best fit for you, right? So our expertise comes when your situation is a little bit more complicated. You want to be a little bit more active in your management. You want to take a bigger role in trying to make your portfolio and your overall wealth position more efficient. That's where we add the most value. It's a better fit for us.
Yeah. And that's what we've noticed as well too. So I hope that answers the question. Anybody else that wants to ask a question? I have a couple more that have come up. if we can take maybe just one or two more. So what are your thoughts on municipal bonds now?
So muni bonds are great. As I say, any kind of bonds I think are going to protect you in this future environment. This because interest rates will start to fall eventually, not as soon as people think, but they will start to come down as there is a recession. So that will help bonds. Now, clearly, municipals have a function of they're tax free. So depending on what your tax bracket is, depends on what your equivalent tax rate will be. Now, that said, there have been cases recently where muni bonds were actually paying more than their corporate counterpart, and muni bonds tend to be safer than their corporate counterpart. So like a triple A rated, the highest rated corporate bond has about the same default rate as a single A muni bond. So it's really rare that these muni bonds will go underwater. If you start getting down to a single A corporate bond, again, pretty rare, but you could get some downgrades, which would reduce the price of the bond, and you would end up losing money. Where muni bonds just typically don't go through that whole process. There, of course, have been some historic cases, Jacksonville and Detroit and Orange County, and it's happened, but these are some very few and far cases over the last 30 years, right? It's not a typical occurrence. So love muni bonds, especially if you're in a higher tax bracket.
Awesome. So I think we can close off. I think what I would recommend for anybody that if this conversation was helpful to you, and you want to learn more, you want to have further, deeper discussion, would love to be able to sit down and have a conversation. So reach out to us and let us know. But just know if there's two things that you could take away. One is, it seems very likely that we're going to be in a recession.
Yeah.
Two, take this opportunity to look at what you have and where it's positioned, right? And be willing to explore and look at what other options and alternatives are. This is a great time to learn. Recession is not necessarily a bad thing. I remember one quote that Warren Buffett said, a recession is a recession for some, but not for all, right? And so really just be willing to explore. We'd be happy to sit down and have a further discussion. Stuart?
If you've risked your portfolio correctly, you can take advantage of the recession that's coming and be further ahead, right? Are you going to dig yourself out of now, again, I'm not saying it's going to be a 30% hole, but if it is, you dig yourself out of a 30% hole versus a 5% hole and you have dry powder, it's a big difference. That's predominantly a lot how Warren Buffett made a lot of his money, is being ready to take advantage of these situations when they come up.
Yeah, and the best thing is that you don't have to do it yourself alone, and that's what I love about what we do, is because it's a team-based approach. We stay in our lanes, in our area of expertise, and we rely on other areas of experts working together, collaborating together. And when you have a team working for you, it's significantly better than if you try to do it yourself. So
yeah, the math bears that out too. They say the do-it-yourselfers on the investment portfolio side tend to underperform inflation, where advisors, even the average mutual fund manager, even though he underperforms the market, significantly outperforms a do-it-yourselfer.
Yeah, absolutely. So we're at the top of the hour. Stuart, it's been an awesome. Every single time I sit down with you, I learn a lot. So thank you. I enjoyed it a lot. So
well, it was great. We got to do this again for sure.
Definitely. I hope everyone enjoyed and hope everyone learned something. So happy June and have a great summer. And look out for more information from us. Cheers.
Absolutely.